Real estate investors, are you paying too much in taxes? Let's talk about it. So today's day 26 of 30 questions in 30 days. So we're down to the last few days here. And today's question, as expected, is okay, well, what about an investor, a non-owner occupied property? How can I avoid paying taxes? Now, a while back, I had posted a video. The question was, how will my taxes be affected if I sell my house? That question was answered for homeowners that actually live in the property. Now, they're asking pretty much the same question, but for non-owner occupied, so investor properties. So here's my disclaimer. I am not a CPA. I am not a tax advisor. I am not a tax professional. Please do not take this as legal advice. What I'm going to share with you are ideas that other clients of mine have taken in my experience. So what I would suggest to you is, if one of these ideas makes sense to you, go talk to your tax professional, explain it, and see what they have to say about it, because I think it's safe to say that everyone's situation is different. So let's go ahead and get started. First, let's talk about what you're going to be responsible for as far as taxes. You're going to be responsible for paying federal taxes. You're going to be responsible for paying good old California, because I'm in California. So you're going to pay state taxes and you're going to pay federal taxes. Now, along those lines, keep in mind this is how it's going to work. Federal is going to say, well, you sold this property, so when you go do your taxes, when you go file your taxes, you're going to owe us money. The state, however, says, no, we're going to change it. We're going to go the other way. So as soon as you close escrow, we want our money. Matter of fact, escrow is going to send us a check. Whenever you go to file your taxes, that's when you could ask for your refund, whether it's a full refund or partial refund. So good old California. So what are you going to be paying? You're going to be paying capital gains. And well, there's two types. There's short-term capital gains, and then there's long-term capital gains. So what's the difference? The difference is if you own the property for less than a year, then you're going to have to pay short-term capital gains, which is typically what your normal tax bracket, whatever that is, you're going to be paying that amount in taxes, capital gain taxes. Long-term capital gains is a house that you've owned for a year or longer. Then at that point, it depends on your tax situation, but you're paying, probably 10, 15% and up. And with the state, what you're going to be paying, again, upfront in escrow sends the check directly to the state. You're going to be paying 3 1/3%. That's 3 1/3%. That automatically is going to go off to the state, and it's going to be your responsibility to show how or why you deserve a refund of that money, whether it's full or partial. That's just how it works. What we're going to talk about next is we're going to talk about the different ways that you can defer the taxes. So let's briefly explain what deferring the taxes is. Basically, what you're doing is you're going to prolong the taxes. So you're going to, rather than pay them now, you're going to pay them sometime in the future. The idea behind that is, in the future, you should be in a lower tax bracket. Think of it this way. If you buy a house, you're in the prime of your life, you're making whatever money that you're making, you're probably in a higher tax bracket. And let's say later on down the road, you're getting ready to retire, or you've already retired, you don't have as much income as you had at one time. And obviously at that point, you're probably going to fall in a lower tax bracket. And then at that point, your tax or consequences are going to be a lot less than compared to when you were younger making more money. So that's going to be the reason why you're going to defer your taxes. So one of the ways is by how do you hold title, right? Do you hold it in an LLC, a corporation, possibly a trust, or do you hold it as an individual? If you hold it in a different entity, then it's possible that you won't have to pay taxes whenever you close escrow. You'll pay taxes later on down the road, but not a chunk of change flying away as soon as you close escrow. Another common way of deferring your taxes is a 1031 deferred tax exchange. So there's a couple things to consider with the 1031. There's some rules or guidelines that you have to adhere to in order for you to be able to qualify. One of the rules is you have to buy a like property. So let's say, for example, you own a office building, a commercial building, and you say, you know what, I'm gonna sell this building, but I want to buy a single family residence. Well, you're not going to be able to do that because it's not like property. On the contrary, let's say you own a single family residence, just a home, and you want to buy a duplex, triplex, or even a fourplex. You could do that because it all falls under the same umbrella of residential real estate. So you got to adhere to that rule, like kind property. The other thing that you're going to have to keep in mind is the timelines. You have a certain amount of time specified in a 1031 exchange to be able to identify properties that you're potentially looking to buy. And then you have a certain amount of time after that to be able to close on any of those particular properties that you identified. So you have to make sure that you adhere to that. The other thing to consider is there's going to be what's called an accommodator. And the accommodator, pretty much they're the middlemen between you, the sale of your property, and escrow. And they just ensure that everything's being done, all the rules and guidelines are being followed. And then that way they can basically give their stamp of approval, and then 1031 works and you defer your taxes. So you're able to successfully sell your house, buy that like kind property, and not have to pay those taxes. Now, keep in mind, pretty much you're not touching your gains, you're not touching your equity, you're not touching your profit on that property. And that's the reason why you do qualify for that 1031 exchange, or one of the other reasons why you do qualify for that 1031 exchange. So that's the most common way of doing it. Now, a not so traditional way of avoiding or paying less in taxes is the following. What a lot of investors have done in the past is what they'll do is they'll pull equity from their property by doing a refinance cash out. And what the reason for that is because in essence what they're doing is they're pulling their equity, but at the same time it's borrowing the money, so it's not actual income that you're making from your property. That can work. It just depends on the situation. I would say factor in, well, what's it going to cost you to refinance? Factor in how much are they going to let you borrow? Because your loan to value on a non-owner occupied or investor property might be less than what it would be traditionally for a homeowner that lives in the property that's doing the same thing. And then secondly, let's say, for example, you can only borrow 70% of your equity. So what you could do, just kind of quick math, is you would estimate the value of your property, multiply that by 70%, then subtract whatever existing loan amount that you have. That remaining balance is what you should be able to borrow. So consider the cost. What's it going to cost for you to do this refinance cash out? And how much money are you going to be able to pull out of the property? And then the other thing is whether or not there's a prepayment penalty. Usually there's not a prepayment penalty, but you should double check just to be on the safe side, because what my clients have done in the past is they'll do a refi cash out. They'll pull as much equity as they can out of the property. Technically that's borrowed money, so they're not going to get taxed on it. And then they sell their property. And there's really not a whole lot left there, so there's not a whole lot left that they're going to be liable as far as taxes are concerned. So other things to consider obviously is the cost to do the refi for business purposes might be a write-off for you. The cost to sell your property will also be a write-off to you. So that's another idea of how you can maybe minimize your tax liability. So as far as can you avoid paying taxes altogether? Well, the only way that you can do that, drum roll please, is to not have a gain, right? So if your property's not, if you have no equity in your property, then you're not going to be responsible for paying taxes. If you have no equity or gain in your property, then there's really nothing to pull or tax you on because you didn't make any money. And then lastly, if you hold that property long enough and you're in a different tax bracket, then it's possible that you're not going to have to pay either. But that's kind of slim to none. So sorry to disappoint you. Technically, there really is no way other than that to avoid paying taxes. The idea is to minimize your tax consequences. What I discussed with you are different options on how you can do that. Either defer your taxes and then pay less because you're in a lower tax bracket, or minimize the tax liability that you have by pulling the money out of the property. But again, there's a few things that you have to consider. Make sure it fits and works for you. And if it does, do not just take my advice and go. Take my advice. The only advice that you should really be taking is go to your tax professional, discuss, and let them be the ones to guide you along that line, along the lines of taxes. All right. Well, thank you so much. We have just a few days left. You're always welcome to comment and ask me questions, DM me, whatever works best for you. I'm a real estate broker, been in the business for well over 20 years, and I'm happy to help. I love this business. I love helping you guys out. So have a great one.